Hi there, this is Elvin from Dr. Wealth. We are not short of Alibaba news. Lately, Alibaba announced that it is going to borrow 4.5 billion US dollars. Okay, so this is coming at a weird time because Alibaba just gave out dividends worth $4 billion for FY 2024. It is the very first time that they have issued dividends. And why do they borrow money immediately after they issue the dividends? This is something that I think some of the investors might be scratching their head and wondering why. Later I'll explain to you. And they also have been very aggressive in buying back their shares because they believe that Alibaba shares is undervalued. So in 2023, they bought back about $9.5 billion. And in 2024 first quarter, they bought back $4.8 billion. So why are they borrowing when they have the cash, right? They still have quite a large sum of cash. I think it's about almost half of their market cap is backed by cash. So Alibaba is not short of cash. Why are they borrowing? So they did explain the use of funds. So primarily it is used to do share buybacks, right? Even more share buybacks. The first tranche will be 14.8 million ADS, which is the American depository shares, right? The Alibaba that's listed in US, and it's going to be repurchased at $80.80 each. Okay, so that is the price then when they came out with this offering. And there will be more additional buybacks in the future. The amount is not confirmed. And lastly is to cover the cost of cap call transaction. Okay, so this is a very interesting one, which I'll also again explain what they are doing here. It's a bit of a financial engineering game, okay? But it's rather brilliant and it is a great deal for Alibaba in my opinion. But there's some more details that you should also understand, right? What these convertible notes are. So they are going to borrow money via convertible notes. It is not like a bet. So it's not like a bank loan, right? So they are going to individual investors or even institution investors, should be largely institution, right? Given the size, and they are going to lend money to Alibaba by buying these notes. Okay, and the name convertible notes means that these notes can be converted into Alibaba shares in the future, okay, especially when these notes are being redeemed, right? And the holder want to convert it. And the conversion will be based on $105.04, which is about 30% higher than the current share price of $80. Okay, so this also means that both the investor as well as Alibaba are confident that the share price is supposed to be much higher than what it is currently, right? At least 30% higher. Okay? And there must be more upside from 104. Otherwise, no investors will buy these convertible notes. Okay? So you can see that actually the conversion rate is much higher, 30% higher than the current prevailing price. Not just convert to shares, the note holders can also request to get cash instead at the redemption or a mix of it. And there are some other clauses, right, by when they can do what, they can redeem either Alibaba or the note holder. But these are the details that I don't think is important for Alibaba shareholders. And what's more important is this cap call transaction. So what it is that Alibaba don't know where the share price will go in the future. They also don't want to end up a few years down the road. Alibaba share price did very well, and when this note holder requests for their notes to be converted to shares, Alibaba will have to pay a high price to buy the shares back from the market and then deliver these shares to the note holders. So they don't want this to happen. So what they did was that they bought call option with a strike price of $161.60 per share, which is 100% from the current share price, right? So they give a room of doubling. Okay, so in case the share price go beyond $161.60, Alibaba can exercise these options and still buy Alibaba shares at $161.60, regardless how much Alibaba share price is going to be then. When is it $200, $300, Alibaba will still pay $161.60. So you can see this is like a protection in case the share price become too overvalued, right? So they can still buy this and deliver shares at this locked-in price. And if it's below the cap price, then of course Alibaba can continue to buy from the open market, or they can also issue new shares and deliver the shares to the note holders who want to convert their notes into shares, right? So that's how it works. So what is the implication, right? How I read this is that Alibaba is borrowing money, obviously, okay, to buy back their shares, to buy more, and that means that they are not just utilizing their own cash, but they realize that there's a way to tap more funds and buy shares back at a much cheaper price because they really believe the share price is really undervalued. Otherwise, they won't be doing this, right? Borrow money to buy back shares. It's a very aggressive move. And also because by buying back shares, the share price will go up, right? Because there is demand for these shares. There'll be less shares outstanding in the market because during share buyback, the shares from the open market become treasury shares, which have no voting rights, which are not entitled dividends, etc., etc. So the number of shares that's being traded in the market gets slower and lower, and therefore the price can get higher and higher. If the supply gets shrunk, demand continues to even stay the same, don't need to rise, right? The price will have gone up. Okay, so that is the effect of share buyback. And definitely Alibaba believes the value of the shares is more than $100 $105.04, right? Likewise, the note holder believe that the Alibaba share price is worth more than that and has the potential to go higher than this. Otherwise, who would buy these notes, right? Because they want to make money from the notes. And also, lastly, there is a limited dilution because when Alibaba do this share buyback, these shares can eventually be delivered to the note holders. And because of the options that they bought, they would not need to buy at a much higher price should Alibaba share price go up too much. Okay, so there is this protection that's inbuilt there. So you can see it's almost like a financial engineering thing. And the benefit is that they are also borrowing at 0.5%. Okay, now it's high interest rate environment. Easily you want to borrow money, you're looking at what unsecured debt more than 10% definitely. If it's secured, collateralized, maybe 7-8%, and they're just borrowing 0.5%. And the risk-free rate, or even the US interest rate is at like 5%, 5.5%. They are borrowing at 0.5%. So it is a no-brainer to me that this deal makes sense. Okay? In fact, I think they should borrow even more if it's just at 0.5%. So you think about it, right? Who will be at the other end of it? If this is such a good deal for Alibaba, who would buy the notes at 0.5% interest rate? So that's why it's a convertible note. Okay, let me explain a little bit. So who will buy these notes, right? They definitely believe Alibaba share price is going to be worth more than $105. Okay, way more, right? So they get an upside because if the share price, let's say, is at $150 and redemption, definitely the note holder will want to convert the notes into shares because they only pay equivalent of $105.04, but immediately they can sell it for $150. Okay, they can net that cap gain immediately. Okay, so they definitely believe that the upside is in Alibaba shares in order for them to buy these notes. And the second thing is that if let's say Alibaba share price didn't go up, they would not need to convert the notes into shares. And they will be able to get their principal back. They can request for cash to be returned to the note holder, and they also get an interest while waiting for this event to happen. So you can see even from the note holder end, they do have some optionality that's here. They can convert if the share price is good, right? If they can still get back the principal if the share price is not good. So either way, they won't lose much. Maybe it's just opportunity cost having their money locked up in these notes. And of course, we have to see whether Alibaba successfully borrowed 4.5 billion. If it is very popular, I think they should do more tranches because it really makes a lot of sense. Borrowing at such a low interest rate and then buying out the share price, buying out the shares, beating out the share price at the same time, I think it's a very beautiful deal. I must say. Okay, I just don't know why the market reacted negatively. I think there's some general sentiment that's affecting the market as well. It's not just limited to Alibaba. I think because the especially the Hong Kong market has gone up so much, it's time to pull back a little bit. So I would attribute more to a macro than a fundamental reason because I do think that this is a very good deal at the end of the day for even for Alibaba shareholders, right? So hopefully you understand what this borrowing is all about. Okay, as an Alibaba shareholder, I hope you can see the positive things out of this. And of course, at the end of the day, it depends on the demand for these notes, right? It's still not sure whether they can raise the full $4.5 billion. Okay, you must still leave some upside for the note holders, otherwise no holders will buy. All right, thank you for watching. Give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.